A big reason many retirees find themselves converting their traditional IRAs to Roth in retirement is for the next generation. Now, this can make a lot of sense as over the last few years, passing on traditional IRAs has become increasingly more expensive. But how should a next generation goal actually affect your optimal Roth conversion strategy? Does it change it greatly, or is it just maybe a secondary variable at most? Let's dig into this. For all retirees considering Roth conversions, your number one goal through conversions should be reducing or minimizing RMDs, otherwise known as required minimum distribution. Now, there are RMDs you will be subject to during your life, but also, more importantly for this video, your heirs are subject to some potentially sizable RMDs as well. Simply put, RMDs are a forced distribution. It is the US government telling you you need to withdraw from your IRAs whether you want to or not. On the screen is a graph that shows the total tax a specific retiree is expecting to pay throughout their life. As you can see, taxes are extremely low initially, and then they cross over a key inflection point, which is their mandated withdrawal age, causing their tax bill to spike and continue to climb for the remainder of their life. The main force causing this cascading graph is, as we noted, RMDs. But the problem with RMDs is that every year you age, you are forced to take more from your IRAs. Effectively, the RMD formula is designed to fully draw down those IRAs if you end up living long enough. Notice on the right-hand side of the screen, the RMD withdrawal rate you are forced to take based on your age. From age 75 to 90, the withdrawal rate more than doubles. Okay, so let's pause here for a second and just leave this loop open. RMDs don't stop at your death. In fact, in some ways, your heirs have even less control over distributions from your IRAs. In 2020, Congress passed a law called the Secure Act. This changed the rules for inherited IRAs. Previously, if you inherited IRAs, you could stretch withdrawals from that IRA throughout the remainder of your life, leading to small and much more manageable RMDs. In place of these stretch rules, Congress now mandates inherited IRAs follow what is being referred to as the 10-year rule. Say you pass away and your heirs inherit your IRAs at the end of 2024. Well, in 2025, a 10-year clock starts and your heirs have to fully withdraw their entire IRA balance by the end of those 10 years. In addition, if you were taking RMDs when you passed away, your heirs will also have to take a specific RMD, much smaller RMD, however, each of those 10 years and have that account exhausted by the end of that window. Now, it is worth noting, outside of small annual RMDs, your heirs will have control over how to withdraw during those 10 years. They could withdraw more or less equally over each of those 10 years. Let's say they inherited a $700,000 IRA. They could withdraw about 10% each year, about $70,000 plus growth. They could also wait 9 years and withdraw next to nothing outside of that small annual RMD, and then withdraw all of that balance in the 10th year. Now, remember, we live in a progressive tax system here in the US, so the default approach for most heirs should be to try to draw down that IRA equally over those full 10 years. Someone is going to save a lot more on taxes withdrawing 10%-ish per year over $700,000 all at once. If we just zoom out here for a second and consider what we've gone over, there are two things we're needing to juggle here with our Roth conversion strategy. While you're alive, our goal is to focus on minimizing taxes that you will see during your life. We want to avoid RMDs pushing you into higher tax brackets. We want to avoid RMDs causing you to owe extra Medicare costs and so on. On the other hand, if you're wanting to pass money on to the next generation, we also have to balance and think about what the tax cost will be when you pass that money on to the next generation. What makes this juggling more difficult is not knowing exactly when you're going to pass away. Pass away earlier than most, and you won't live long enough to have RMDs affect your life greatly. On the flip side, live a very long life, and RMDs during your life will be the main focus. And the RMD formula, even if you didn't perform Roth conversions, will cause you to draw down that IRA far enough, and therefore tax costs to the next generation will be small. The main takeaway in both situations is that RMDs are coming either way. It's just a matter of who will bear the tax cost. Consider this as well. Depending on your situation, RMDs to the next generation can potentially be more problematic. Let's say you are 86 and have a $1.3 million IRA. Your RMD this year would be approximately $85,000, or equivalent to a 6.5% withdrawal rate. If you pass away, however, and pass that money on to just one heir, remember that they have 10 years to exhaust that IRA. If we assume equal distributions through those 10 years, your heir is looking at approximately $130,000 annual withdrawals plus whatever growth. So in this example, the RMD is quite a bit higher if passing money on to the next generation. But keep in mind, this may not always be the case. Let's say you are dividing between 3 heirs. Now the next generation RMD can be broken up across 3 people, leading to smaller withdrawals, which reduces the next generation tax costs and lowers that RMD as compared to yours if you were still alive. The reason I bring this up is because if we are accurately assessing what effect planning for the next generation will have on your Roth conversion strategy, we need to figure out which of these 3 categories you fit into. Will passing money on to the next generation be more costly tax-wise? Will it be about the same? Or will your heirs be able to withdraw at lower tax rates, and thus you may actually want to pass on tax liabilities? I see many retirees in a camp where they want to pass on all Roth assets, and therefore pass on wealth tax-free. There are times, however, where you can actually save on taxes overall by passing on some traditional IRAs. What would be some of the times where passing money on the next generation is wise? Say you have multiple heirs and most of them are in lower paying jobs. Sure, any RMD they have will stack on top of their normal working income, but they have lower brackets that they can fill up. On the flip side, if you have only 1 or 2 heirs and they are maybe doctors, lawyers, or work in some other highly paid profession, there's a good chance you want to avoid giving them an IRA of any reasonable size. But let's talk about how these situations work into your overall Roth conversion strategy. Now, the good news here is optimal Roth conversion timing for most retirees means you can accomplish both goals at the same time. Saving on taxes for you as well as the next generation is what I mean here. For most families, the biggest opportunity window for Roth conversions will happen between ages 65 and age 70. Yes, there are opportunities for some before 65 depending on your healthcare package. And yes, there is some opportunity between age 70 and RMD age. But the biggest opportunity is concentrated in a small window. This is good because in both cases, long-term tax problems are solved at the beginning. It would be a lot tougher if Roth conversions for the next generation were hypothetically best taken towards the end of your life, and Roth conversions for saving on taxes during your life were best taken care of at the beginning. Then juggling these 2 situations would be enormously complex. The reason I bring this up is because I hope to help correct a mistake that I see quite common with next generation planning. Some portion of retirees will watch a video on the 10-year rule and think, holy crap, my IRA balances are going to riddle my kids with a big tax bill as it currently stands. So they set out to fix this problem very quickly. Through a very short period of time, they set out to convert all of their IRA assets, so regardless of when they pass away, their kids will receive a fully tax-free gift. And I understand the urge to take an approach like this. It's simple and really just gets the problem out of the way. But remember, our goal through withdrawals and conversions is to maintain the lowest tax rates possible. And so the first step in making a Roth conversion plan that includes planning for the next generation is to ask if next generation conversions are even necessary or if conversions based on your own life kill 2 birds with 1 stone. For instance, here is the exact same situation I just showed, but rather than maxing out the 32% bracket, this couple maxes out the 24% bracket for 2 years and then maxes out the 22% bracket, which will turn into 25% post 2025 for the remainder of their retirement. Now, using this strategy means this couple is consistently eating away at that IRA balance, but doing so in a way where they avoid Medicare increases outside of the first 2 conversions and are able to convert at much lower rates across the board, thus resulting in bigger tax savings. Now, depending on when this couple passes away, they will likely leave an IRA balance from, let's say, $500,000 to as much as $1.4 million. Now, if they have children that are in higher paying jobs and thus are in tax brackets larger than the 28% bracket, this couple may want to strategically do some bigger conversions earlier to leave a smaller IRA balance, so additional conversions for the next generation make sense. But if their kids are in the 28% bracket, they are more or less in a similar tax situation to their kids, and converting more or passing on an IRA balance will be pretty close to equivalent. Then if their kids are in the 25% bracket or lower, they will actually want to leave an IRA balance like this to the next generation. Hopefully this thought process makes sense. In order to lower their IRA balance lower than what it already is, they're going to need to move into the 28% bracket. So if they are passing money on at a tax cost lower than 28%, they should not do those additional conversions. If they would be passing on an IRA balance and that would be withdrawn at a rate higher than 28%, well, then they should perform those 28% conversions earlier in their life. Consideration number 2 here is realizing how many heirs you will spread that tax liability to. For example, when we showed that comparison before asking the question, who would have bigger RMDs, you or your heirs? The answer to that question will depend on the number of heirs you have. If you have one child, then no doubt the tax cost of leaving an IRA will be increased. But if you have, let's say, 4 heirs, we can see the depth of which you can spread out that tax liability. It's also worth noting here that your heirs are unlikely to have the exact same tax situation. Because of this, know that there's no rule that you need to equally split every account between your heirs. For instance, we've worked with couples before where, say, one child was a lawyer and the other was a teacher. We found a split that made sense where passing on more Roth to that lawyer and more traditional IRA to that teacher saves substantially across the board on taxes. Now, in this situation, you'll need to pass on a little bit more wealth to the person receiving the traditional IRA balance, as they're going to still owe taxes, whereas the Roth recipient won't. Then finally, consideration number 3, and one we've already alluded to effectively plan for the next generation, you need to have a reasonable idea of what the tax consequences will be to that next generation. Now, I don't mean to make it seem like we're going to have some perfect assumptions here, or even that you know exactly how much your heirs currently make and what their future tax situation will be. This is a directional point rather than a specific point. But let's say you live in a state with no state income tax, and you are passing money on to your son who is married, and they have a taxable income around $110,000 living in Pennsylvania. This is a general look at their tax graph based on where they would sit today. Now, obviously this can change with career advancement, but for now, let's just take this at face value. This is a couple who can inherit a traditional IRA and still have quite a bit of room to fit in RMDs at some reasonable rates. In this case, they have about $90,000 of annual room in the 22% bracket. Now, Pennsylvania is a state that has an income tax, but they do not tax distributions from retirement accounts. So we would not have to add in state income tax here. Given this, it wouldn't make sense for parents to convert at really high tax rates just to pass on tax-free assets, because this couple has quite a bit of room to afford some inherited RMDs. On the flip side, say you have a daughter who is a single doctor in California with $235,000 of taxable income. With state taxes, this person has next to no room to receive inherited RMDs at a reasonable rate. They are almost immediately taxed at a combined rate of 44%. Given this, a retiree shouldn't try to convert everything all at once at rates lower than 44%. Remember that retiree still likely has room to convert themselves unless they're at much older ages or maybe have a terminal illness. But a retiree with an heir in this situation should try to avoid leaving any IRA balance due to the great tax costs. This would be a situation where next generation cost is higher than the retiree's cost. If I could just offer one more anecdotal summary of what we've talked about so far. In most cases where a retiree wants to save on taxes during their life, but also has a next generation goal with Roth conversions, the vast majority of the time, both of these goals are aligned. An optimal plan for your life is also the optimal plan for the next generation. However, in some cases where heirs are either in significantly higher or lower brackets than you, there's some tougher juggling that needs to happen. Now, every situation is different, but broadly speaking, we want to allow the next generation goal to adjust our conversion strategy to some extent. For instance, let's say maxing out the 22% bracket through our conversion strategy and maxing out the 24% bracket are two strategies that are pretty close in expected tax benefits to our situation. We will typically allow the next generation consequences to control which conversion target we choose. If the heirs are in a much higher tax bracket, we'll go with a more aggressive conversion strategy to ensure those IRAs are emptied or mostly emptied by death. If the heirs are in a lower tax bracket, we'll take the longer, more conservative strategy. But again, with all of this, keep in mind your entire situation, your goals, and the options you have. By far, passing on a Roth to the next generation is best. They will have to empty this account in 10 years as well, but there are no tax consequences to doing so. A taxable account is the next best account to pass on to the next generation because they receive something called a step-up in basis. And then finally, we have the traditional IRA. This account should not be demonized as it is a valuable account that we can use to our advantage, but it has to be controlled. You generally want to leave some IRA to the next generation. You just don't want to leave a massive IRA. Also, if you have another goal like giving to charity, your IRA can be a perfect targeted account to leave to charity. I hope this video will help you develop a better tax and estate plan for your retirement. If you are interested in Roth conversions and want to avoid 10 common mistakes that plague many retirees' tax plans, click here to learn more. Always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.